Hey, good morning. This is a continuation of what we were discussing, and then this is part two of our dividend policy and retained earnings discussion for the day, right? So we left off from here, and then I'm going to go now to the next the factor, and then if you are a company that would need to declare dividends, what are the things that you need to consider other than what we have learned on the previous portion of this video, which is on, hey, only declare dividends unless you have something that you can invest the money or your retained earnings or net income into, like a project that's profitable with a high margin, right? Or high rate of return. Now, if you have decided what is the amount that you need to declare as dividends based on which formula, I'm going to go back a bit, okay? Based on this formula, we just say, hey, here's your net income or your retained earnings minus the amount that you want to reinvest as funds to a profitable project, then that's dividends. So once you have decided that, and then you have an amount, you need to now look at what are the other things that you need to consider. And these are, let me just make sure I have this. Do you actually have enough cash to pay for the dividends? Why? You might have a retained earnings that's higher than your cash that you have on the books right now, or meaning on your records or in your bank right now. So you do not want to declare everything as dividends if you don't have enough cash to support it, because it might be counterintuitive or counterproductive, I would say, to actually have a big amount, say a retained earnings of 10 million. Then you have projects of, say, 4 million that are profitable. So I said 10 million of retained earnings minus 4 million of profitable projects equals 6 million. 6 million is your potential dividend declaration for that period of time. And then what you do is that you look at your cash balance and then you only have cash of 2 million. So what would you happen with the remaining 4 million of dividends? You don't want to loan the money to pay for that because that would increase again your cost of capital. So it does not make sense, right? So things to consider, check on your cash position. It's not good to think about it wherein your shareholders receive dividends, but they're thinking you're using your funds wisely, but in fact you actually took a loan to make a declaration of dividends and pay them. So that's not the best use. That's not being complying with your fiduciary responsibility as a CFO or as a finance professional in that case, because there's a cost to acquire those type of capital. if you if you decided still that even though you don't have much money and then you wanted to still do like pay dividends, then do you have access to capital markets? Do you have access to get a loan or anything to fund it? And then also, maybe you want to declare dividends because you want to have some control. So this is the dividend policy, not on cash distribution, but on stock split or issuing stocks as a distribution rather than cash, which is a cash dividend. And then is the shareholder position. Sometimes, a stockholder or a shareholder, like for example, you and I, as a retail investor, if we get dividends, we're taxed on our current tax rate, which we're going to go through in a different slide, or ordinary income. So if you're earning a 24% bracket as a single person or a married person or whatever your status is for tax filing, then your dividend, if it's an ordinary dividend or any other non-qualified dividend, it will be taxed on a higher bracket, like ordinary income. But if it's actually stocks that you're receiving and then you're making money out of it, it might be a capital gains tax, which is a lower tax bracket or a lower rate compared to dividends. So that's something that you want to also consider, right? And then we're going to go through that one later. Okay, let me just scroll here. Now, the legal rules. So what's the legal rule? So most states, I would say most states, so dividends should not impair that's why it forbids to impair any of the firm's capital contribution. And then may only be distributed, your dividends, based on past and current earnings. Remember, net income as accumulated is retained earnings. Why? Because it needs to protect the creditor, and then it needs to um, payment of the dividends equal to the retained earnings might jeopardize the company's operation because now you don't have any more internal funds to do it or to support your business operation. Let's take a look at it on this way. So common stock plus retained earnings, we know, is actually what? Equity on the balance sheet. So for this company, it's 30 million right now. But this 30 million consists of the common stock and also a retained earnings. Now, when we ask or when you're asked, what is the amount that you can declare at maximum for dividends? It's basically the 20 million. You don't declare and then you don't deduct the amount of dividends that it would actually negate or it would reduce the common stock. Why? Common stock is actually what though? We talked about it on the IPO process. When you go through an IPO, when you sell your stocks, it goes through the IPO process, right? The proceeds from the stock is actually the common stock. Anything in excess of that par value is actually additional paid-in capital. You only max out your dividends up to 20 million because you don't deduct it 25 million because it means that you are returning the shareholders' initial contribution of capital to you. So there's a different taxation. At the same time, I'll do point number two. You do not declare dividends normally to max out or to zero out your retained earnings. So basically, you don't zero out your retained earnings. Why? Because if you zero out your retained earnings, what will happen to your remaining projects or you don't have internal generated funds? I'll make a note of that one, right? I would say normally, you normally do not declare wipe out your RE, your retained earnings. Why? Because you need to have internal funds. And then the question is that do you have enough cash, right? But legal rules is that states forbids to pay dividends that would impair the initial capital contribution. It could not eat up to the 10 million. For this reason, dividends may be distributed only from past or current earnings, which is retained earnings. To pay dividends in excess of this amount will mean the corporation is returning the investors their original capital contribution, which is 10 million. Okay, so those are the rules on. I remember there's one taxation rule which I need to give this proper citing. Is that if you have accumulated retained earnings but you're not distributing dividends for the longest time, there might be accumulated retained earnings tax rules. But let me check on that, and then I'll get back to you guys about a penalty for not declaring dividends because you've been retaining everything all your life. Now, the dividend policy consideration also is that even with the laws against having dividends exceed the path of current retained earnings, may be inadequate to protect the creditors because retained earnings is an accounting concept. And then there's no way to verify the current liquidity of the firm. So in this case, theoretically, I would use the word theoretically, you can declare dividends up to 15 million. However, here's the however, right? You only have enough cash of 500,000 to apply and pay. So I have retained earnings of 15. Theoretically, that's your max. But you only have 500,000 or 500,000 of cash to do. Then most of your items or most of your assets are tied up on inventory and plant equipment. So why do I say that? Because I know in accounting, current total asset ties up with total liability and stockholders' equity. Total liability, stockholders' equity. This is like your balance sheet, right? Then total assets. These are assets. So your current earnings right now is actually, say, for example, 1.5 million, which is now part of your retained earnings. Why? current earnings is on the profit and loss statement. And normally it gets closed in the retained earnings, but your potential dividends is 15 million, but you only have enough cash of 500,000. So those are the things that you need to consider, right? How much do you need to declare as dividend? Now, we wanted to make sure that your cash position would still be enough that you don't just pay out of cash on the cash dividend declaration without reserving anything for your needs. Uh, why? If you pay out and liquidate, use all your cash, what will be the next payroll would look like for you as a company? Would you actually have enough collection that you can support the payment to your employees, the payment, the current amount due to your vendors? So something that you need to consider as well. Now, there's a desire for control. We talk about we talk about if you want to take control, the dividend policy might be actually desire for control, right? So a dividend policy is to pay out to your investors. So maybe another way of doing it, based on the same number of ownership of stock that they have, but another way to take control back of the stocks would be for you to buy back the stocks that you have issued out back to the company. So money still goes out of you as a company, but you're buying back the shares of stock. Why? You are now reducing the number of stocks that are outside in circulation. In the process, increasing your earnings per share. Why is that net income um, earnings divided by the number of shares that are outstanding, right? Earnings per share. So if you're reducing it, and then at the same time, you're getting more control. You're taking out the control. You're diluting the control by the outside parties and going back to you. So that's one way of looking at it on a dividend policy. So something to consider. Now, this is the one that we talked about that qualified dividends can be higher than capital gains. So company would rather repurchase stock rather than raise a dividend. Repurchasing stock means that you are still paying your shareholder, but you're repurchasing it and then reducing the number of stock in circulation. But your shareholder will get the fair amount of share of money that will be on the capital gains tax compared to declaring dividends, which might be an ordinary income taxation. I'm going to go here. So this is actually just want to make sure this is the 2021 tax rate, right? This section, 2021. So what I did was I showed you the snippet of 2024, just to be sure. I pulled it out from the taxfoundation.org. I could have pulled it out from the IRS, but this one shows you easily view once. Now, there is let me just make sure that we understand what a qualified dividend, right? So a qualified dividend is a subset of ordinary dividend that's taxed in a lower rate. In order for it to be considered ordinary dividend or qualified dividend, the dividend, so let me just make sure. In order to benefit from a lower tax rate in dividend, the investor must hold the stock for at least 121 days and for more than 60 days before the stock goes ex-dividend, which we'll explain there. The dividend must also be paid by a U.S. corporation or a qualified foreign corporation. Because the rule is that all dividends are basically taxed on ordinary income. Ordinary income is basically your tax requirement, your tax rate. For example, if I'm making 200,000 this year in 2024, my tax bracket will be at 24%. So it would mean that ordinary dividend will be taxed at 24%. A bit high, right? Now, if it's actually this ordinary income on ordinary dividends, but if it's a qualified dividend, then it would mean that it might be a lower tax bracket And then that lower tax bracket can actually be something that's more beneficial, but only if the investor, you, holding it for at least 121 days and for more than 60 days before the stock goes ex-dividend and it's paid by a U.S. corporation or qualified foreign corporation. So it has a different tax rate, but it has some requirements. That's why dividend has a taxation impact to the shareholder. And then remember, if we talk about the discussion we had before, dividend declared is not deductible for tax purposes for the corporation compared to interest expense. Interest expense through debt financing, those are actually deductible for tax purposes, the interest expense. Now, that's dividend. That's why the question is that maybe it would be good if it's only a capital gains, right? So if it's capital gains, they are taxable about 15 to 20% depending on your taxable income. So short-term capital gains or ordinary dividends are taxed at the taxpayer's rate. So let me just. So the long term, it should be a long-term capital gain. And long-term capital gain, you should have held the asset for more than 1 year. Then that would mean that it will be taxable on a lower bracket. So that's why a stock repurchase will be taxed on, say, on a capital gain, assuming it's 15%, better than a stock dividend that can actually be taxed on, say, 20% or so, depending on your tax bracket, or even if it's a qualified one. So the tax paid is $2 for dividend here, and the stock repurchase at $1.50. Lower, not as much on a per stock basis, but if you are a big shareholder of a lot of the stocks of the company, then that can mean a lot of tax cash out differences. Okay, so that's one thing that needs to be considered is actually the taxation part of the dividends. Now, these are important for our quiz also. These are the calculations, so I wanted to go through with you. So cash dividends, although it's being said when we talk about dividends, it's like a one lump sum amount, right? That you declare per share. But it can be paid by the corporation on a quarterly basis, so 4 times a year. And then one of the things that you would want to compute is actually the dividend yield. What's a dividend yield? It's the annualized, so not the quarterly, right? So remember, we just talked about something 4 times a year. So you add those four dividends that you receive. So that's annual now because there's 4 quarters in a year. So the annual dividend per share divided by the current stock price is actually your dividend yield. Example, if the dividend is $1.39 per share and the stock is have a market value or the current stock price is $63 per share, then the dividend yield is actually 2.21%, which is actually $1.39 divided by the market price of 63. Now the question is that what is the term dividend payout? So it's the percentage of the dividend per share divided by the earnings per share. So that's important also. If the earnings per share for the same company is 534, so earnings per share, you deduct the dividends already, right? With a dividend of 1.39, then the dividend payout ratio is actually 26%. So it's $1.39 divided by the EPS or earnings per share of $5.34. So that on your quiz, so be sure to make to remember the calculation on the dividends. And then there's a question also that relates to theory. So be sure to actually answer that as well on the reason why dividends are declared, what are the caps, or any other of the theories that we discussed during this video. Now, on the dividend dates, we have the ex-dividend date, the record date, or holder of record date. Some books would call it record date and the payment date. So there are three important dates when declaring dividends. We'll explain further on the next page.